The global aviation industry moves billions of passengers across the planet every year. It is a sector defined by engineering marvels and immense scale, pulling in over $900 billion in annual revenue. But beneath that massive top-line number is a financial reality that is surprisingly fragile. Across the global industry, net profit margins routinely hover between a razor-thin 2 and 4%. Even during peak travel years, a vast majority of commercial carriers fail to earn back their cost of capital. They operate at a net economic loss, meaning that the aviation business essentially destroys money just by existing on a daily basis. The prestige associated with flying is largely a financial illusion. The structure of the business itself ensures it operates on the absolute brink of financial ruin. The core of this fragility comes down to what an airline actually sells. Standard retail businesses can store unsold goods in a warehouse for next season. In contrast, airlines are forced to sell perishable inventory. The product is the flight itself. The moment an aircraft's doors close, the revenue potential of an empty seat drops to zero. But while the income vanishes, operating costs do not. Fuel, crew salaries, and maintenance fees remain exactly the same. Carriers are locked in a daily, desperate race to maximize their load factor, filling as many seats as possible just to break even on the operating costs. A minor dip in consumer demand turns a route from a thin success into an immediate financial liability. The financial burden begins with the equipment itself. Acquiring a single modern commercial jet, like a Boeing 787 or Airbus A350, costs up to $300 million. To bypass these massive upfront capital requirements, airlines turn to leasing. Today, nearly 58% of the world's commercial fleet is leased from third-party companies, rather than owned by the airlines operating them. This provides short-term flexibility, but it locks the carrier into massive, inflexible monthly rental payments. The leasing company expects its check, whether the plane is flying at full capacity or sitting grounded on a tarmac. This dynamic places the airline squarely in the middle of a hostile value chain. They must negotiate with monopolies, like local airports dictating gate fees, and duopolies, like aircraft manufacturers who control the global supply of planes. The suppliers dictate the prices and practically guarantee their own returns. The airlines act as the shock absorbers for the entire ecosystem, taking on the operational risk and fighting over the remaining scraps of profit. This chart breaks down an airline's budget. The largest operational risk is turbine fuel, consuming up to 35% of expenses. A crude oil shock rapidly inflates these costs, aggressively crushing the airline's tiny net profit until it completely disappears. Carriers attempt to manage this volatility through fuel hedging, signing financial contracts to lock in future fuel prices. It is a complex gamble. If market prices spike, the hedge saves the airline. If global oil prices drop, the airline is stuck paying above market rates while competitors fly cheaper. When fuel expenses rise, carriers cannot simply pass those costs on to consumers. They are locked in cutthroat price wars with low-cost carriers, forcing ticket prices steadily downward to maintain market share. Between uncontrollable external commodity costs and relentless downward pricing pressure from competitors, an airline is caught in a permanent, suffocating squeeze. The economic math ensures the margins remain near zero. Now, take these brutal global rules and apply them to the Indian domestic aviation market in the early 2000s. It was an environment that took a hostile economic model and pushed it even further toward the extreme. Indian carriers faced a unique trap regarding fuel. State-level taxes levied on aviation turbine fuel made it nearly 50% more expensive than global benchmarks. Fuel alone could eat up over half of an airline's total revenue. At the same time, the consumer landscape was being aggressively disrupted. Low-cost pioneers like Air Deccan trained passengers to expect dirt-cheap, bare-bones travel. Price became the sole deciding factor for ticket sales. Operating in India amplified every single structural weakness of the aviation model. It created an ecosystem where only the most ruthlessly frugal and hyper-efficient operators had any chance of survival. Against this backdrop emerges Vijay Mallya, the flamboyant liquor tycoon who had built a successful, lifestyle-driven empire around United Breweries. Looking at a low-margin, capital-destroying industry, Mallya made a fateful decision in 2005 to launch his own aviation venture, Kingfisher Airlines. Rather than lean into the strict frugality the market demanded, Mallya's vision actively ignored it. He insisted on a premium experience, featuring brand-new aircraft, personalized in-flight entertainment, and high-end catering. He backed this vision with staggering financial commitments. Between rapid initial expansion and the eventual buyout of competitor Air Deccan, Kingfisher strapped itself with massive, rigid lease rentals, reaching up to 1,000 crore rupees annually. He brought massive fixed debt, premium luxury, and heavy fuel consumption into an environment where price was everything.
Global airlines generate hundreds of billions of dollars in revenue every year, but the capital required to earn those dollars is immense. A single wide-body aircraft, like a Boeing 787, costs upwards of $250 million, and a major carrier might operate hundreds of them. After paying for that fleet, the fuel, and the staff, the average net profit margin hovers at just 3.9%. Because of this, most of the cash an airline pulls in is incinerated by its own operating requirements. This chart shows the industry power curve, tracking the economic returns of airlines globally. At the top, a small cluster of profitable outliers, but the graph takes a steep drop. 78% of global airlines operate at a net economic loss. These companies are caught in a structural squeeze. Because margins are so thin, even a minor change in costs or a slight increase in competition can eliminate profits across the entire sector. When nearly 4 out of 5 operators are losing money, generating a profit is a statistical anomaly. In commercial aviation, baseline survival is the primary metric of success. This squeeze is created by two forces. The first is a rigid ceiling on what consumers are willing to pay. Because the market is fragmented and air travel is often seen as a commodity, passengers are sensitive to even small price increases. We saw this during the capacity war at Brussels Airport. When low-cost carriers like Ryanair and Vueling flooded the market with new routes, the excess of seats forced airfares down to levels where no airline could operate profitably. Competition pushes the price ceiling toward the cost of the flight itself. This diagram illustrates the second force, the operating cost floor. While the price ceiling is flat, the costs of fuel and labor are volatile. When fuel prices spike, they drive the floor upward, crushing the 3.9% margin against the consumer price ceiling. This leaves airlines with very little room to react. If fuel costs double, an airline cannot simply raise ticket prices to compensate. If they try, passengers will switch to a competitor, leaving the carrier with empty planes and the same high fixed costs. The Indian domestic market takes these global challenges and intensifies them through specific domestic policies and extreme consumer expectations. This chart compares global average fuel costs to aviation turbine fuel in India. Due to state taxes, Indian fuel is nearly 50% more expensive. While fuel costs pushed the floor up, domestic disruptors pulled the price ceiling down. Air Deccan's 1 rupee tickets permanently shifted consumer expectations. Passengers demanded low-cost travel, even as operating costs remained high. Running an airline in India meant operating in a high-pressure environment with almost no buffer. There was simply no room for financial error. Vijay Mallya entered this environment in 2005 with the launch of Kingfisher Airlines, leveraging the brand of his United Breweries empire. In 2008, the 20-year boom in global aviation ended. The financial crisis destroyed business travel and consumer demand almost instantly. At the same time, the price of international crude oil skyrocketed to $140 a barrel. This pie chart shows the impact on Kingfisher's balance sheet. Because of India's high fuel taxes, fuel costs suddenly consumed over 50% of the airline's total revenue. This left the company with almost nothing to pay its aircraft leases or its staff. The structural trap had closed. Kingfisher was legally committed to massive lease payments, but it was burning cash on every flight it operated. To stop the bleed, the logical move was to ground planes and downsize the fleet, but political pressure interfered. During the meeting with the finance minister, Mallya was urged not to downsize in order to protect jobs. He was told the banks would support the airline if he kept flying. Kingfisher continued to fly half-empty planes, and the losses reached 7,000 crore rupees. By 2012, the income tax department had frozen the company's accounts, and staff went on strike after months without pay.
The end came when the regulator suspended Kingfisher's license. The fleet was grounded permanently, leaving rows of identical red planes parked uselessly on the airfield. Kingfisher's collapse was a collision between an expensive luxury strategy and the difficult economics of the aviation market. Mallya built a brand on high fixed debts, leaving the airline with no buffer when fuel prices and the global economy turned against it. Imagine running a billion-dollar empire, and in a single moment, the money simply stops. The screens go red, the accounts lock, and the lifeblood of your entire operation drains away instantly. The physical breakdown followed immediately. Without cash to pay lease rentals, which ran up to 1,000 crore rupees annually, lessors aggressively began confiscating the aircraft, leaving Kingfisher's signature red Airbus jets sitting dead on the tarmac. Then, the fuel ran out. Suppliers like Hindustan Petroleum completely cut off deliveries of aviation turbine fuel because the airline had accumulated massive unpaid dues. The human toll was severe. Employees went without pay for 15 consecutive months. Engineers refused to sign the mandatory technical logs that cleared planes to fly, and widespread staff strikes crippled whatever operations remained. Kingfisher didn't slowly lose popularity with passengers. It suffered a violent, immediate operational death spiral, triggered entirely by a sheer lack of liquidity. The fatal blow arrived in October 2012, when the Directorate General of Civil Aviation officially suspended Kingfisher's flying license. The airline was permanently grounded, suffocating under a cumulative debt that exceeded 15,000 crore rupees. The financial fallout ripped through the banking sector. Major lenders, including the State Bank of India and Indian Overseas Bank, were forced to classify the massive loans as non-performing assets amid mounting allegations of financial fraud and bypassed banking norms. The airline's founder, Vijay Mallya, fled to the United Kingdom, becoming a fugitive fighting extradition, while authorities moved to liquidate his remaining empire. Mallya's personal ruin dominated the headlines, but his company's collapse was actually masking a deep, systemic economic flaw inherent to the entire aviation sector. While Kingfisher's collapse was a uniquely Indian tabloid sensation, the financial mechanics at work are visible on flight lines across every continent. Economists call this the capital destruction dilemma. Look at this global distribution of profitability. Even with billions in revenue, 78% of all global airlines generate a net economic loss. Only a tiny sliver of outliers ever see positive returns. This trap catches established giants too. Legacy carriers like American Airlines have been forced into Chapter 11 bankruptcy to shed debt and renegotiate labor contracts just to keep operating. The capital required to enter the market is immense. A single wide-body jet costs $250 million, a massive fixed cost. When external shocks hit, like crude oil spiking to $140 per barrel, surging fuel costs consume the budget, shrinking profit margins to zero. Because airlines sell a highly perishable product, where an empty seat's value vanishes the second a plane takes off, Kingfisher wasn't an outlier. It was a localized flare-up of a global pattern, where traditional scaling often leads to capital destruction. This comparison puts the reality into perspective. Even during record-breaking years of recovery, the global airline industry averages a net profit margin of only 3.7 to 3.9%, roughly half the average achieved by other major global industries. Because the cost of flying an additional passenger is so low compared to the massive fixed cost of moving the plane, airlines are effectively forced to sell tickets at cost, leaving no room for error. Operating on this economic knife's edge means that a minor labor dispute or a brief economic downturn can obliterate profitability across the entire sector. High top-line revenue is an illusion. Generating cash through sales does not guarantee corporate survival if the underlying unit economics are broken. Kingfisher's fatal strategic error was chasing 27% market share and brand glamour while ignoring the liquidity required to keep the lights on. If flying physical planes is structurally unprofitable, how do modern airlines manage to stay in business? The answer is the hybrid model. Network carriers have converged toward the middle of the market, combining unbundled passenger services with ruthless cost discipline. The true profit engines of the industry are now ancillary fees and loyalty programs. Today, major airlines often make more money selling frequent flyer miles to credit card companies than they do selling seats to passengers. Business longevity relies on an economic model resilient enough to survive when the good times inevitably end. To uncover more hidden mechanics of business and strategy, subscribe to Brand Brains.